I don't mind going through it because I see a beautiful picture at the end.
Well, it has been nearly a week since President Trump announced those reciprocal tariffs. And tonight, reactions are still coming in. The stock market had gone down, but today the market did rebound for a while. A live look now at the Dow Jones, the S&P, and the NASDAQ shows all have climbed, but there is still a lot of uncertainty. Here's Channel 2's Claudine Ewing with advice from a financial expert.
It's your money, and for many, it's your money for the future. Where should you invest? Stocks have been falling, losing gains as the president's tariff deadline gets closer.
Some friends of mine who ask, should I be buying on a dip? Is this an opportunity? And our advice is that there's just too much uncertainty out there to consider doing something like that, because we have no precedent for what's going on right now.
O'Gorick has this chart which shows returns in gray, but to get a return, you have to endure the declines in red.
Each of those years, you've been tested. And many of those years, you've got significant double-digit returns down. And I think that this is really a more accurate picture of what it's like to invest. So volatility is part of the price you pay for higher returns over time. It's not timing the market, it's time in the market.
Again, it's time in the market that makes a difference.
And there are times when it really tries your patience and you think everything's going to hell in a handbasket and you could swear that it's going to zero and I must jump out to protect myself. Just don't do it.
Short-term treasuries are best to own. That's according to O'Gorick.
What's worse? Anything that would be leveraged, or what we call levered, which means you're looking for twice or three times the performance of NVIDIA or Amazon or something like that. Those would not be good. If you've got a 50-50 portfolio where you're 50% in stocks, 50% in bonds, well, you should take some comfort in the fact that you're only absorbing perhaps 50% of the market's decline. And those bonds are actually going up in value as interest rates decline. So it may not be as bad for your account as you may think. If you're young, it should probably be almost all in stock, preferably a stock index, such as the S&P 500 or the Dow Jones Total Stock Market Index, which is all U.S. stocks.
On your side in Buffalo, Claudine Ewing, Channel 2 News.